Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for June 2nd of 2024. Well, welcome everybody to the 6th month of the year. We have quite a few charts on the equity markets, some charts on housing here, and some other assorted charts that I thought were pretty interesting in the reading this week. We're going to start with this one. This is an overlay of the S&P 500 index, which is shown here in the black line, and then overlaid in the red here is the Citigroup Economic Surprise Index. And as we've been following this over the last couple of months, we've noted that we've had a couple months of decline in this, and it's really a bit unusual, although the correlation you can see here is actually pretty loose. But we have had a bit of a retrenchment in the Economic Surprise Index, meaning the data has not been as robustly on the upside surprise as it has been, particularly earlier this year. But then, of course, we see the stock market continuing to move higher. In fact, when we look at, the deviation from the trend line, we can see here clearly that it has gotten a little bit of ahead of itself. So there's going to be several charts in here that I'm going to submit to you, might build a case for some interim volatility in the stock market as we head a little bit closer to the election. We certainly get into the summer months, and people are, tend to be more absent, and volumes in the stock market tend to be a little bit lower. And sometimes you see a little bit of dislocation based on relatively little information. So I'm just saying here that, with this large deviation that we've seen, which again, we saw back at the second quarter of 2022, we saw a large deviation heading into the fourth quarter of last year. So again, not uncommon, but it helps to set the stage from time to time to present a little bit of an incremental volatility in the investment markets. Here we have capital spending versus earnings growth. So this is actually a really positive takeaway as we've been kind of monitoring earnings and stock performance over the last several months. We know that earnings multiples, price to earnings, has gotten really ahead of itself, and we've got a chart on that coming up, particularly with the concentrated, high-profile Magnificent Seven stocks that we've all been talking about, and specifically NVIDIA within that group. But good news here is we see continued increases in earnings expectations as the feeling is settling in, not only within the corporate environment, but also within the investment analyst community, that earnings are going to, in fact, go higher. So we see earnings in the orange line here. This is a three-quarter lag, but this is year-over-year earnings expectations. You can see that they're now trending up to about 10%. And usually when you see that, again, to the extent that this is corroborated by what executives for the publicly traded companies think, it tends to follow with increased capital spending, which is obviously an economic benefit. You get increased business spending, which is very important to GDP. So as you can see here, it's very suggestive that CapEx is going to continue. Again, people were cautious for quite a while, thinking, okay, are we going to have a recession? And then it became, are we going to have a soft landing? And now it seems like it really does feel like a foregone conclusion that we're going to have a soft landing, with some of the data, as we just saw in the prior slide, the Economic Surprise Index kind of trailing off a little bit, but again, not in anywhere near catastrophic territory. But this is a good slide if you're looking at like staying power within the equity markets. You got more capital spending. Obviously, that you have to have the confidence on the part of company management to be able to commit to capital spending, and that means that you're expecting future growth. Along those same lines here, we've got increased confidence on corporate America. You see the buyback announcements have really moved higher after a bit of a lull in 2023. But you can see clearly in this blue line evidence of a multi-quarter progression and increase in buyback activity. And so this is symptomatic, coupled with the fact in the prior slide that you've got incremental capital spending probably on the horizon. So not only are companies spending on increasing their capital stock, increasing the productive capacity of their enterprises, but you also have companies that are also taking excess cash flow and repurchasing their stock. So this is all very positive for the equity backdrop. Something else I thought was very interesting, a Gallup poll here indicating that stock ownership on the part of individuals continues to move higher. You can see this question very specifically is, the interest in investing and I guess the commitment to investments in the public markets, whether it's in individual stock or a fund or in a qualified retirement account. You can see that continues to move higher. And this not only contributes to maybe some volatility within some of the kind of those meme stocks we talked about, like GameStop and some of those, but also as well as the well-publicized high flyers like we already mentioned, NVIDIA. So you got a lot of people that are really trying to run after and chase that caboose as that train is out of the station and pulling away. Something else we've been monitoring is stock and bond correlations. You can see here, again, speaking very statistically here, one standard deviation move on either side of the mean or the average, represents 65 to 66% of all of your observations are going to be within that band of one standard deviation. And when you punch through that, as we have, that is highly unusual, and to the point we're almost 2 standard deviations, which means that you generally only see that less than 5% of the time, and that's kind of where we are now in terms of stock and bond correlation. So what am I talking about? That just means that stocks and bonds moving in the same direction, and where diversification doesn't help you as much. And we know that was certainly the case in 2022 when both stocks and bonds dropped. But actually, to a large extent, that has continued on. Now, there's obviously internal dynamics which create that scenario where you've got interest rate movements and stock price movements that, seem to kind of lend themselves, put those two asset classes moving in the same direction. But what this does is it challenges the assumption that diversification with fixed income is the right move. Now, my response to that is that's true. So it becomes a lot more important to select within fixed income and select within equities. What are you investing in? Because there are elements within each of those categories which do help to offset and lower your risk profile. Here we have another chart kind of talking about earnings. This actually came from Richard Bernstein in New York. They do awesome work on this. And so, their work is showing that we're getting a higher percentage of S&P 500 publicly traded companies that have greater than 25% trailing net income growth. And you can see that is actually increased. So as we've been talking about a little bit earlier here, that the earnings expectations have increased, and now overall the index is expected to increase earnings over the next year by 10% or so. You can see that there's greater participation. So it's not just a subset. We're improving the breadth of success stories within the index, and that's really positive. Now, we still have a very narrow market, and that is a risk, but this chart indicates that we have greater breadth with at least the earnings growth potential, and I view that as very positive, and that number right now is about 33%. I talked about this slide a few minutes ago. Here we have valuations for some of the various segments of the market, including overseas markets. You can see the Magnificent Seven there, about 38 times earnings. Very highly valued, astronomical valuations, and these are largely unsustainable. And generally, one of two things will happen. Either the earnings will catch up to the valuation, or you'll have a valuation reset. And obviously, there's a lot of interest, a lot of money flows into these Magnificent Seven stocks, and in particular, NVIDIA. But we have seen NVIDIA posts some pretty strong earnings reports and have provided some pretty encouraging guidance. And so, there may be some support for valuations at these levels, but it comes with a lot of risk. Now, if you kind of go towards the right here, you see the equal weight S&P 500 valuations are about 17 times, which very close to long-term averages. You've got the equal weight ACWI index, of which this is a global index, but the U.S. accounts for about 60% of this index here. And you can see valuations there a little closer to 17, 16 and a half. And then as you scroll to the right, you get into some of the foreign markets, emerging markets. You can see 15 times S&P small cap. That's a U.S. Index. You see, about 15 times. So more attractively valued than even the larger caps. And then Europe and China are even cheaper than that. So we just got through talking about confidence on the part of corporate America in terms of increased capital spending, increased repurchase activity, so on and so forth. Now we're going to talk about the analyst and the investment community. And so what we have here, we've got two different looks at this. So on the left-hand side, we actually have funds out there, mutual funds, and what their average cash levels are. You can see that they've been coming down for the better part of, I'd say, about 9-10 months now. And you can see the average, we're now below the average there. Cash as a percent of assets under management now is below 2%. And so that would be a bullish sign if you're tracking those things. On the right-hand side, you've got global fund managers. So this would be institutional managers. This would perhaps be a little bit more encompassing, but these are more the institutional managers as opposed to the mutual funds themselves. As you can see, their cash levels are also coming down. So their confidence level is increasing. Their current cash level is about 4%. You can see how that's kind of carried through time. So that's a pretty low level, honestly, when you get right down to it. And there have been lower levels of cash that we've seen in the past, and typically they do foreshadow a little bit of volatility when you get to a confidence level that's high, that's that high. But again, it's very bullish on a very interim basis for the stock market. On this chart, we have the market cap of the largest stock in the S&P 500 index relative to the 75th percentile stock. And so the 75th percentile stock is a large stock in its own right, but as we know, we've been, certainly over the last year, we've seen a really strong concentration of very large stocks. In fact, top 10 represents 35%, 40% almost of the index. So you can see the large stock relative to the 75th percentile, when that gap's higher as it has, that shows you that we have probably less market breadth. Now we have been seeing on the earnings side, we noticed that a few slides ago, that earnings breadth is improving. We're getting more companies that are witnessing strong year-over-year earnings growth, but that hasn't manifested into prices just yet. And this is a clear example here in this chart that, back in 2020, we had this type of deviation, 2000, 1932, 64.73, and 2009. And those were periods, those were all periods that had a fair amount of volatility associated with them. And again, I don't mean to scare people, but, as you see more earnings breadth, you see the high flyers, you see their valuations really cascade, above and beyond the rest of the market. And we saw that in the last chart there with PE ratios as well. This chart I would kind of characterize as a bit of an educational piece. So this goes back obviously a very long way. This is from Game of Trades, and I love their work. Terrific perspective going back all the way to 1913, just so you kind of think about that. That's 110 years. But there were certainly points within that. If you go to 1929, and we all know what happened that year, and then you go to 1968, and then you go to basically 1999. And if those were your points of entry, and you succumb to a lot of behavioral investing biases, that where you get emotional and you trade at the bottom, you're apt to lose, 60% of your investment if you are not diligent and if you don't have a long-term horizon. And I'd say, a little bit of a selfish tone, you don't have somebody that's kind of coaching you on all these behavioral biases to try to inspire you to remain steadfast in your investment objective here. But there are certainly times in the history of the stock market where volatility has not been your friend, and but over the long haul, you can see clearly the rate of growth that is available to you if you can remain steadfast. Talked about emerging market equities, and we talked a couple slides ago. We talked about valuations. There is a valuation advantage there on emerging markets, but you can see here very clearly that U.S. equities have had a significant trading deviation, meaning that they've moved at a much more rapid pace than emerging market equities. And again, we're using these little statistical bands that we call standard deviation. And so anytime you see something hit a standard deviation band on either side, it catches your attention. And so basically, we have emerging market equities, their valuations relative to U.S. equities are at 50-year lows. And so, I certainly use that to submit the case that emerging markets are attractive for investment purposes. What you're waiting for is a catalyst, and you want to make sure that that you're not trading into kind of a value vacuum where you don't have a catalyst to realize that. And I think emerging markets are slowly getting their footing. There's certain markets like Europe, which is a developed market, has seen a little bit more of a tougher go than the U.S., but other emerging markets have suffered at the hand of a stronger dollar. Usually weaker U.S. dollar is a benefit to emerging markets. And so when you see dollar reversals potentially coming down the pike with U.S. interest rate cuts on the horizon at some point, that ought to help emerging markets to a degree, and you might see this deviation begin to decrease somewhat. Now this looks like a real busy chart, but we're going to transition here into a couple of kind of interest, a couple of points of particular interest to me. This is kind of like work locations and the whole issue of remote working and office space being vacated by large employers, blah blah blah. In the green line, we have exclusively remote. And so as you can imagine, during the pandemic in 2020 here, you could see that number really skyrocketed and we spiked. But ever since then, we've been coming off of this, and we've plateaued at a level about 25 to 30% exclusively remote. That's kind of held steady for a better part of 2 years now, and but obviously much higher than it was before we had the pandemic. And you can see here, those totally on site went from 60, and then we're kind of holding around 20 now. So we have basically a third of the workforce, or excuse me, basically 40% of the workforce, or a third of the occupancy levels that we had previously. And that's pretty significant, but you do see the hybrid number, which is in the blue, continue to move higher. And so that is reflective of kind of what I think is a new normal here is, you got workers that are going to be spending some days in the office, some days on remote, and that's just kind of like what we're going to get used to here over the next 5 to 10 years. Now we are going to talk about real estate, residential, some interesting dynamics here. We've got more inventory in our local area. Again, we're broadcasting here from the Austin, Texas area, and I know a lot of you are not local, but here in Austin Metropolitan Statistical Area, or MSA, We are seeing an uptick in months of inventory. That's good. That means it's getting, injecting a little bit of health into the local real estate market, but it is still very tight. And as we'll see in the coming slides, still a fair amount of dislocation in housing altogether. Here we have manufacturing. This is the Dallas Fed. This is another regional survey. Before we get back into housing, I thought I'd mention this. So here we've got basically the business forecast, and this is a survey. I don't participate in the manufacturing survey, but I do participate in the services survey for the Dallas Fed. But you can see manufacturing still remains below zero. We did have a little bit of a couple of upticks over the last year, but it's still a bit sluggish as it has been nationwide. And then the outlook for general business activity is also taking a little bit of a downtick, and that has remained negative. And so as we see here, even in Texas and our Federal Reserve region, where things have been a little bit soft, and we've seen little green shoots of growth, that we still have a long way to go before I think we can say, hey, we're in the all clear and things are really healthy and operating on all cylinders. So an inflation note here, this is pretty interesting. This caught my eye, and we have been monitoring the various components of inflation. And even though it remains sticky and it remains a headline, and we're not going to get all the interest rate cuts that we thought we were because inflation has been sticky, the silver lining here is that we have a fair number of the components of inflation that are running below 2%. And as we've noted before, real wages and rents remain high, and they remain kind of the sticking points. And we've had other things like commercial and residential insurance rates, and at various points we've had auto prices that have kind of been sticky. But here, this is kind of prima facie evidence of what I think is going to materialize, and we're going to resume. We're going to have this flattening out of price levels and inflation, and then we're going to begin to see a resumption of the decrease. But it's going to be slow. But right here, the takeaway from this is that we have essentially greater than 50% of the consumer price index components are now running below 2%. Now we'll get back to housing. Here we've got positive percentage of positive views of the housing market, and I'd say that that's really a misnomer, because all in all things are still pretty pessimistic. And this is an index again from Gallup. Obviously they've been doing great surveys for many decades and many generations, frankly. And you can see that housing optimism is still very, very low. Rent versus buy. So now we have an interesting dynamic that we had an inflection point back in 2022, and we saw essentially homeowners now are spending more income on owning a home than renters are, and you can see that deviation manifested in that red circle there where we are now, and that seems to be as wide a gap as we've seen since we reached that inflection point. So it is pretty interesting, not surprising that we've seen a lot of multifamily and high density come on the market, which tends to be suited more for renters. And so, right now we're at a very interesting spot in the rent versus buy equation. Mortgage payments do remain high. Interest rates have come off their peaks, but as you can see here, going all the way back to 1994, again, you have to overlay some kind of annual inflation onto this. So either that or kind of deflate it year by year because of inflation. But the aggregate rates, notwithstanding the fact that inflation plays a part in this, you can see how they've really jumped higher in a very short period of time. New home supply, we've been tracking the stick builders, and they have been somewhat optimistic. They've been putting a lot of product on the market. We know that we've been undersupplied for well over a decade in housing, Obviously, they've gotten after it, and again, not a new phenomenon, but as you can see here, they're trying to retrace a major deficit. We have, as this graphic indicates, that we have the highest supply in new homes that we've seen since the 2008 global financial crisis. A couple charts on pending home sales and active listings. Got a lot of data here this week from Redfin, which is really good. The rest of this data, we've got pending home sales. You can see the red bar there represents a fairly dramatic drop after a couple of frankly positive surveys, but you can see that this data can be pretty noisy on a month-over-month basis, and obviously this drop was much greater than expected. That's in the upper left. Lower left, we've got pending home sales here in the U.S., and you can see that as an index is at trough levels that, again, we haven't seen for quite a while. Obviously, 2020 was a very awkward period, but you got to go back many years to find a level beyond that we've seen. And then on the right-hand side, and I've got another chart full of Redfin data here, but you can see very clearly that active listings of homes for sale up 15%. You've had pent-up desire for sellers to want to get houses on the market. Affordability remains really strained, however, but clearly there's an attitude that more people want to get houses on the markets. And this is not just new homes, which we know that there's a huge supply of. We just saw that. But these are primarily used existing homes, and we do know that part of the market is much, much more significant than the new home market. Here we have median sale prices that, again, oddly enough, for all the conversation of the rapid rise in prices and then kind of that settling out that we had for about the better part of a year, prices are on the rise again, up 4.3% year over year on a 4-week moving average there. However, transitioning from the left to the right-hand side, what's clear though is that these prices are going up, but 6.4% of listings had price drops. And so this is evidence of a market that's really still trying to feel itself out. And so I'd say that there's some dislocations here. You can see that relative to prior years that we've had more homes that have witnessed price drops. And again, some homes are selling very quickly because they fit a particular need in a particular location. And we do know that it is difficult to kind of make these kinds of assertions on a national basis, which really this is. But just suffice it to say that there's still some things in the residential real estate market that are in the process of being worked out. Now we'll talk about the regional banking sector. As we've been, ever since Silicon Valley Bank, we've been talking about, the risks inherent and, and what happened with the rapid rise in interest rates and a lot of these regional banks that frankly do the majority of the commercial and industrial loans in this country, witnessed quite a bit of a shock on their balance sheet. Now, that doesn't mean that they have to close their doors and they're out of business or even to the extent that they may be insolvent, although in a few cases, well publicized, like Silicon Valley Bank and then Citibank or New York Community Bank, NYCB, it really was an existential threat to them that required a bailout or, in some cases a merger, but you can still see that situation persists. So, banks really haven't regional banks haven't completely worked through this yet. So you still have some exposures out there. They seem to be at least consistent to a degree, so they're not necessarily getting worse, but they're not certainly have not gone away. Here we have corporate profits. Getting back to what we were talking about earlier, you can see that the trend line is basically up. This is year over year. And again, you can see that that does jockey around quite a bit, and certainly from one decade to the next, but we're on averaging an uptick right now. And here we have corporate profits quarter over quarter. So We have had a little bit of a deceleration, if you will. Most of the data over the last 4 or 5 years has been positive with regard to corporate profits, notwithstanding the gyrations around the pandemic. But we did have a bit of a downtick, but as we showed in the prior chart, that the trend line still remains up. Talk about the GDP revisions that we did see for the first quarter. Now we will next month, July, we'll get the first reading of the second quarter, which will end at the end of this month. But this is generally we get the first reading of the first quarter data at the end of April, and then we'll get May revision, and then we'll get one final June revision to that first quarter data. So. But this represents the first revision of that. So first quarter, as it was originally reported, economic growth was up 1.6% on an annualized basis. That was revised last week down to 1.3%. Now, don't panic over that. What we saw was a revision, downward revision in what was estimated to be total consumer spending. And you can see that on the left-hand side here, that represented the majority of that revision. We also had inventory growth, which was revised down. But on the flip side, we had housing and business investment, which we've been talking about, both revised higher. Now, on the right-hand side, this is a trend that has been at play for quite some time, and that is the fact that the consumer spending, even though it was revised down, still remains a very strong tailwind for the market. You can see that most of that is in services. In fact, we had a goods retrenchment. Basically, goods spending was negative, and it took away from overall economic growth, but spending on services was still extremely strong. And finally, this chart on GDP, you can see the various components, and you can still see in that gray area that represents total consumer spending, which has been the biggest tailwind, for quite some time to the market. And we did see business investment, which we've talked about, and that is likely to remain a contributor to growth. And then in addition to that, we also saw government spending, which I think is apt to slow a little bit. Again, there's lots of ifs on that comment because of the presidential election and the election cycles and what's going to happen to control of Congress, and there's so many things that could happen there. But I would just say on balance, expect government spending to come down, consumer spending to hold in there, although I think consumer spending will come down, and it certainly has over the last couple of quarters. And then we also saw net exports go down, and that just meant that we still have demand for imports, and so our imports exceed our exports because our country seems to be doing better economically than most of the rest of the world, and so that's why we have a negative trade balance, and that's why in that orange bar there on the far right that we see net exports dragging growth down a little bit, as well as those inventories. So in the labor market, we continue to monitor this real well and really closely, I should say. And job openings by establishment side, we see in the small business category, the 1 to 49 employees, that continues to trend down, albeit it has run higher overall than the large establishments, which are over 50 employees. But again, all of those are trending down. It's kind of like this settling out in the labor markets. You can see the Challenger layoff announcements on the right-hand side, and you can see how that dovetails with initial jobless claims, which have been eking up a little bit, but you can see the correlation of these two data series that would suggest that, and by the way, the Challenger data in that blue line is advanced 3 months. So it does tend to be a leading indicator of sorts. When you have large companies that are paying attention to, large companies, particularly that are publicly traded, that obviously have earnings to manage, and they'll be your first. That'll be your first group that'll show stress in the labor market where they're going to shed jobs and they're going to announce cuts. And then usually that's followed by initial jobless claims in the broader economy over time. And I think that's what's playing out. So, labor market's been strong, but I think this shows evidence here that labor is going to continue to soften up a little bit. And that's really not necessarily a bad thing. We just don't want this thing to crater. And on a positive note, we have gasoline futures. This is in the black. We've got NYMEX gasoline futures. We do know that we've seen, crude prices kind of ease a bit, and that translates into basically all of the distillate products that follow from crude. And you can see here that gasoline futures are dropping. You can see the average gasoline price in that purple line, and that's coming down at precisely the right time. So we have typically increased demand during the summer months for driving, and this represents a little bit of a tailwind for consumers as they fill up their tank. That'll do it for the chart pack this week. Hope you have a wonderful week, and we'll talk to you again soon. Take care.